Well, hello and welcome back to Principles of Accounting 1 here at UDC in the spring 2023 semester. I am still your host, Dr. B, and apologize for being away last week. I was in a conference all week that took a lot of my time, unfortunately, but I'm happy to be back in the classroom with all of you. First and foremost, I want to commend all of you for a wonderful, wonderful job of completing the work from last week. So thank you all very, very much for your hard work in completing the work from Chapter 10. I really do appreciate that. Again, I apologize for being away, but I do sincerely appreciate your hard work. It means a lot to me. I think it means a lot to your classmates, and hopefully it means a lot to you as well. So thank you for that first and foremost. I want to very quickly, where are we in the classroom? We're in week 11. Amazing how fast time goes by, isn't it? Week 11, Module 3. Here's the information for you. For this week, we have a discussion board. Discussion board is on the employees and employers' perspective of payroll and the costs associated with payroll. So this is an important discussion, and I really would like you to complete your original post by Thursday night and then respond to two of your classmates by Sunday night. I'll also be in there posting this in the discussions and responding and engaging with you because this is a really important discussion. And I want to make it as engaging as possible. So that's for Sunday night. So we're in week 11. Next week, we will have Chapter 12, and then we'll roll into 13, 14, 15, 16, and then we're done with the semester. So we're really only about 4 weeks away from the end of the semester. It goes by fast. April seems to really cruise by. So you're more than welcome to work ahead, by the way. If for whatever reason you think the course is going too slow for you and you want to work ahead, or maybe you got some stuff coming up in the near future and you want to work ahead, you're more than welcome to do that. There's nothing stopping you, okay? I always prefer that you go with the rest of the course, but if you want to work ahead, you're more than welcome to do so. So having said all that, let's talk about this thing called payroll and current liabilities and all of that good stuff. So, can anyone tell me in the classroom, those of you on the call, what's a current liability? What is that? What is a liability? And then tell me, what is a current liability? You already know this. I'm sure that you do. But what is a liability? And then what is a current liability?
Liability is something that you owe, a debt that you owe.
Correct.
And current liability is one that you currently owe.
Yes, Maxine, absolutely. It's one that you currently owe. Yes, absolutely. So what does that mean? When is it due?
Oh, within the 30, I think net 30 pay the.
Technically, yes. For a bill, yes. For accounts payable, that's correct. But what?
Okay, before close of year.
Yeah, exactly. It's due within 12 months. Yeah,
Yes,
anything that's due within 12 months or less is considered to be a current liability.
Okay.
Yeah, very well done. And as you mentioned, accounts payable, that's when we've received a bill and have not yet paid it. And we usually have to pay bills within 30 days or less, depending on when the bill is due, right? So that's an accounts payable. But that's also considered to be a current liability because it's something that we owe within 12 months or less. So current liabilities are liabilities, something that we owe within 12 months or less. And we're also going to talk about this concept called payroll, which is a part of liability. As an employer, I have to pay my employees, which means it's a liability because I owe my employees money through payroll. So payroll is considered to be a current liability. We'll talk more about this. So as you know, in talking about liabilities, a current liability is something that's due within 12 months or less. The word liability simply means you owe something to someone else. It's a liability to you. Liability to the company is I have to pay for goods and services that the company has been utilizing. So, whether that be payments on a loan for a piece of equipment or paying our employees for the wages that they earned through working for us, or I'm paying my bills, I'm paying my utilities, I'm paying my rent, etc. Anytime you owe someone else, it's a liability. If it's due within 12 months or less, we consider that a current liability. If it's due in greater than 12 months, it's a long-term liability. The current 12 months or less, long-term greater than 12 months. It's a very clear definition. Current 12 months or less, long-term greater than 12 months. Yeah, very easy. This nice little chart here at the bottom of this particular slide, I find it interesting because it describes the percentages of liabilities for very large companies. It's very, very interesting to see this kind of information because we can see that companies can be across the spectrum when it comes to their operating cycle. It's a little fascinating piece of information. Sometimes a liability could be uncertain. Uncertainty in a liability simply means we don't have all of the information. When we receive a bill, it typically tells us who we owe the money to, when it's due, and for how much, the amount. Those are the three standard things that you would see on any bill that you receive, whether that's personal or in business. Okay? But sometimes you might receive a bill that it's unclear. Unclear who to pay, when to pay, and for how much. The reason why it might be unclear is that the bill came from a different company, but it has a different company on who to pay it to. For example, I received my Pepco bill. It says to pay it to Exelon or something like that, right? In other words, what I'm saying is the bill may have come from the name of the company that you know, and the who to pay it to area has a different company name on it. It's kind of like doing business as, which is the well-known name, but it's not their actual corporate name, right? So who to pay can sometimes be uncertain. When to pay it. Sometimes you might receive a bill and it says due upon receipt. What the heck does that mean? When I got it? When you sent it? I don't know. Okay, due upon receipt. What does that mean exactly? When I received it? Because we know the post office ain't the best at getting stuff to you on time. But when I received it, could it be late? I don't know. It says due upon receipt. Sometimes when the bill is due can be unclear. So if it says due upon receipt, it typically means due right away. But that's unclear. Okay? Usually means it's within 30 days of the invoice. Again, sometimes it's unclear. And sometimes it's unclear of how much to pay. Here's an example of this. Remember when we talked about a 210 net 30? Means that we receive a 2% discount if we pay the bill within the first 10 days. Otherwise, the whole thing is due within 30 days. 210 net 30. Talked about this a couple weeks ago. That can make the amount that we have to pay unclear. If I pay it in the 10 days, it's a 2% discount on the total amount. Otherwise, the whole thing is due within 30 days. What happens if I put it in the mail on that 10th day? Right? I still get the discount? I don't know. That can make it unclear. The overall point is it's very important to be as observant with the details when it comes to liabilities as possible. We want to make sure we know who we're paying it to, exactly when it's due, and the exact dollar amount. Don't make it a penny less. Don't make it a penny more. It needs to be the exact amount. Don't round up or down. Okay? Don't get in trouble now. So that's unknown liabilities. And of course, we have what we call known liabilities, known current liabilities. These are bills that we know we have to pay. No, we got to pay it. I don't know what happened to that bottom one. I apologize. There it is. Okay. That's kind of weird. Known liabilities. These are things we know we have to pay. Accounts payable. These are the bills that we've been receiving from the day-to-day operations that have not yet paid. Accounts payable. I received the bill. I put it into my accounting system with the date, the dollar amount, who I'm paying it to, and then I'll pay it when it's due. It's accounts payable. Sales taxes payable. In business, we have to pay taxes, just like everyone else. Okay? The business has to pay sales tax based off of what we sell. Now, of course, not all businesses pay sales tax, but most of them do. For example, a convenience store that you like so much, the 7-Eleven. Who doesn't love 7-Eleven? Of course I do. The 7-Eleven, they have to pay sales tax on everything that they sell. Okay? Whether it's gasoline or whether it's something at the convenience store, whatever, it doesn't matter. It could be a slushie, it could be a candy bar, it could be a gallon of gasoline. They have to pay sales tax. So for every what's the sales tax rate in DC these days? Does anyone know? Is it like 6%? Something like that.
I believe it is 6% at this point.
I think you're right. Yeah, I think it's 6%. Okay, so thank you, Maxine. So for that means for every dollar that the business takes in sales, they have to pay 6 cents to the DC revenue department, the tax collection agency for the district, right? So the way it works is that after 3 months of, typically at the end of every month, we should be doing this. We total up all of our sales for each month. We identify everything that is taxable, and we multiply that sales amount by 0.06. And that amount is what we, the business, have to pay to the DC Tax Revenue Agency. And so we do that every 3 months. You want to total it up every month and do a general journal entry for, you want to debit sales taxes payable, credit sales tax. Okay. Or I'm sorry, it's the opposite. Debit sales tax expense, credit sales tax payable. Journal entry helps us to identify the exact amount that we owe the DC sales tax agency. We do that at the end of every single month. At the end of the third month, so once a quarter, at the end of each quarter, we have to pay that. We have to remit that to the sales tax agency. And we usually just do that online. It's quick and easy that way. You could write them a check, but yeah, things get lost in the mail. You don't want to get in trouble with any kind of taxes. Just stay away from tax trouble. It's not worth it. So that's sales taxes. Any question on sales taxes? We're okay? All right. The third known liability is called unearned revenue. Who can tell me? Do you remember this conversation we had about unearned revenue? What is unearned revenue? Who can tell me this?
Would it be unearned revenue? It's like when you like if somebody orders something online and the customer hasn't received the package yet.
Correct. You're absolutely right, Damon. Yes, very well done. So unearned revenue means that we received payment from our customer, but we have not yet provided the good or the service to the customer. So in Damon's example, we had a customer who purchased something from us online, and we haven't shipped it out to them yet. That is exactly an example of unearned revenue. Very well done. So unearned revenue, that's a known liability. We know exactly what we've collected from our customers and have not yet shipped it out or provided the service. Very well done. The fourth one is called a short-term notes payable. Short-term notes payable. We talked about this one, I want to say about 2 weeks ago, maybe. I think it was about 2 weeks ago. Can anyone tell me, what is a short-term notes payable? Please, short-term notes payable. That was a while ago, 2 weeks ago, I think. Short-term notes payable, do you remember? What is it? No, no one remembers? Oh, come on. Okay, I'll help you out. Peter, I saw you. I think you know.
Yes, it's an obligation to pay a specific amount plus interest within a year.
You got it. Exactly right. Very well done. Yeah, you're absolutely right about that. So oftentimes the way a short-term notes payable works is that it's one of two things. Either the business decided to take out a short-term loan to cover various obligations, okay? And they have to pay that back, and it has to be within a year. Exactly right, Chiquita. So that's the concept of short-term, right? 12 months or less. So either the business took out a short-term loan, short-term notes payable, or fell behind on our invoices. In other words, our vendor calls us and says, hey, Dr. B, I noticed your business, you haven't paid me in like 90 days. So we're going to convert your invoices and we're going to turn those into short-term notes payable, which means I have to pay them the original balance plus interest, based off of that loan document we talked about. It's the promissory note. Yeah, very well done. And then, of course, we have payroll liabilities, which is what we're going to be jumping into here shortly. Payroll liabilities is when I owe my employees what they earned. I've not yet paid them. They worked the 2 weeks, haven't processed payroll yet. Okay, it's an accrual, right? You accrue hours when you work. You punch in on the time clock at 8 a.m., 9 a.m. if you're lucky, and you work until 5 o'clock or later or earlier if you're lucky, and then you punch out after the 8 hours. And sometimes you got to punch in and out for lunch break, right? Now, every time you hit that time clock, punching in and out, you're accruing hours. It's based off the hours that you're working, that you're actually working, right? That's how the employer knows how much to pay you. It's your hourly rate times the hours worked. So if you work 40 hours a week at whatever dollar amount, it's 40 hours times that dollar amount. That's what I have to pay you. It's not exactly that much, though, right? Because, yeah, you got to pay some taxes. You got your federal income tax. You got your DC income tax. Or state, if you want to call it state. So you got your federal tax, your state tax. Sometimes there's a local tax involved. Depends on where you live. Okay. Back in New York City, there's a city tax for income as well. So you got your federal, state, your city taxes. These are all forms of income tax that comes out of your paycheck. And then on top of that, you got Social Security. You got Medicare. And you might also have some other things going on there, some other deductions. For various reasons, your retirement, 401k, 403b, whatever's retirement, IRA. You might also have child care. You might also have child support. You might also have, what do they call for the kids' schooling in the future? It's the thing you save up money for the kid, for when they go to school. 403b, I think it is, something like that. So there's a lot of other deductions, is what I'm saying. And after all those deductions come out, whatever's left is what you get paid, right? Those are all those taxes that I'm referring to. Those are payroll tax liabilities that the employer has to pay to those respective agencies. And then, of course, the employer has a separate liability to the employee, the payroll itself that they have to pay to the employee. Don't worry, I'll break all this down for you a little bit more here in the next 10 minutes or so. But payroll can be very complicated, okay? So that's why I want to spend some time on this. And the last one here is called multi-period known liabilities. Multi-period known liabilities. Sounds complex. It's not. I promise you it's not. Multi-period means multiple months, or in some cases, multiple years. Multi-period known liabilities. That's kind of like saying rent is due every single month. The mortgage is due every single month. That's a known liability, and it covers multiple periods. You might have a car loan, a loan for machinery, loan for equipment, a building loan, whatever. This covers multiple periods. In other words, I'm making the same payment every single month for a long time. Sometimes years, right? So that's what it means to be multiple period known liabilities. So don't stress too much over that term because it doesn't mean anything. It's all it simply means is that I pay the same amount every single month for a long time. It's a fancy way of saying it. Let's talk more about the taxes. Okay. The business has to pay sales tax unless you're tax exempt. Those are the only types of businesses that don't have to pay taxes, sales taxes, are tax exempt businesses. What's a tax exempt business, you might ask? A nonprofit. A nonprofit agency, they don't pay sales taxes. They receive what's called a tax exempt certificate from the tax agency, which means they're exempt. They don't have to pay taxes, sales taxes specifically. Other examples might include religious organizations like a church or a variation of a church, right? Any type of religious organization, they're sales tax exempt as well. Government agencies don't have to pay sales taxes. Yeah, it's nice. The rest of us do. I don't know why they don't have to. But those are some examples of organizations that do not have to pay sales tax. But we, unfortunately, do have to pay sales tax. The rest of us. So here's an example of a sales tax payable journal entry that we make. This one just so happens to be a single sale. This is one sale that Home Depot made. So a customer came into Home Depot. They bought this is probably wood, I imagine, $6,000 worth of wood. Somebody came in to buy, obviously not in DC because this is 5%. Maybe this was printed a few years ago, so maybe it was. Somebody came in and bought $6,000 worth of wood. The sales tax is 5%. So if it's 5%, we take $6,000, the sale amount, times 0.05. 0.05, of course, being the conversion of 5% to a decimal, right? So 0.05 times $6,000, the sale amount, gives us the sales tax amount of $300. So here's the journal entry that we make. We debit cash $6,300. Because remember, the customer bought $6,000 worth of wood, and there's taxes involved of 5%, which is $300. So the customer pays us the sale amount plus the taxes, $6,300. Then credit sales $6,000. Very straightforward. I sold $6,000 worth of stuff. I then credit a separate account called sales taxes payable, $300. The reason why we separate this out is because we have to know exactly how much the company needs to pay to the tax agency. Because since sales taxes payable is a liability account, it shows up on our balance sheet under current liabilities. And that amount on the balance sheet is exactly how much I have accrued over the month or whenever. Then that's the amount I need to pay to the tax agency. You see? So, in other words, the business kind of acts as an intermediary middleman for taxes. I collect the taxes from my customer, and then I pay that exact tax amount to the tax agency. You see? I do the same thing for my employees, and we're going to talk about that here shortly. Unearned revenue, just as Damon was referring to earlier, is when we've made sales but have not yet provided the service or the goods. We made sales, but have not yet provided the service or the goods. Here we have an example of Selena Gomez making some concerts. Fantastic. She's got 8 of them coming up. Okay, fantastic. Good for her. So she sold $5 million in concert sale tickets for 8 different concerts. Okay, great. So we debit the cash for $5 million. That's $5 million coming into the business. We then credit an account called unearned revenue. In this case, unearned ticket revenue, but it's the same thing. Unearned revenue is the account we credit, which is a liability account. It's a liability because we have not yet performed the concert. We have not yet provided the service. So we debit cash, increase our cash, credit unearned revenue to increase our liability account, which is unearned revenue. And then when Ms. Gomez provides the service, the concert, she gives the concert. Her first concert was on October 31st. So then we need to recognize the revenue from that concert because once she performed the concert, she provided the service. We then need to recognize the earned revenue from that service. So we debit unearned revenue to reduce that liability, and we credit revenue. You see? What this does is it's taking it out of unearned revenue and putting it into revenue. Now you'll notice the dollar amount, $625,000. Why not the whole $5 million? Because this is only 1 out of 8 concerts. We do this at the end of each concert. Recognize the revenue. Okay. Short-term notes payable, as we talked about earlier, Chiquita, we said that the short-term notes payable is a short-term loan that the company probably took out for whatever reason. We have to pay it back within 12 months or less. Yeah. Some information that you would see on a short-term notes payable. Specify future date within a year or less. It has interest. We got to pay on it. And sometimes this happens for various reasons. We borrowed money from a bank, or we didn't pay one of our vendors for a couple of months. Yep. There's other reasons too, but those are 2 reasons. Here's an example of short-term notes payable. We accidentally didn't pay one of our vendors back right away, so it took us a little longer than expected. So they called us and said, hey, we're going to turn your accounts payable into a notes payable. And I was like, oh, I'm so sorry. And so they said, no problem. So we're going to convert that accounts payable to a notes payable. So here's the journal entry that we make for this. Oh, and we also agreed to pay them a little bit up front because, got to try to keep them happy. So we debit the account payable for the full amount of the account payable. We credit cash for the amount that we're paying them, in this example, $100. And the remaining $500 is on a 12% interest. So we put that in the remaining $500 into notes payable. And then, of course, we'll make that payment when it's due 60 days later. When it's due 60 days later, we debit notes payable, $500. We debit interest expense, $10. How $10? We take the principal amount, in this case $500, because remember we paid $100 earlier. Keep them happy. So $500 is what was left, and that was what went into the note, times 12% interest. So 500 times 0.12 times 60 days, months, yep, over 360. Now remember, there's only 360 banking days in a year. There's only 360 banking days in a year, not 365. The U.S. federal government recognizes 5 banking holidays every single year. Okay. So I got the $10, and then, of course, we paid $510 to satisfy this short-term notes payable. Another example here, we borrowed money from a bank, $2,000 worth, 12% interest, due within 60 days. So the bank gave us the full $2,000. So we debit cash $2,000, we credit notes payable $2,000. And then the 60 days later, we paid them. We paid the bank back. So we debit notes payable $2,000. We debit interest expense $40. We credit cash $2,040. How $40? It's the face value of the loan, $2,000, times interest of 0.12 or 12%, times 60 over 360 banking days. That's how we got $40 of interest expense. So it's important to remember that interest expense formula. You might see that again in the future on, I don't know, final exam maybe. So face value times interest rate times number of days over 360. And use the order of operations stuff, right? So you want to do that number of days over 360 first before you calculate the rest of it. Sometimes if the note goes over 2 accounting periods, we need to make an adjusting entry. So for example, if we took a loan out from a bank on, we'll say December 1st, and it's for 2 months, so 60 days, at the end of December, we need to make an adjusting entry to record the interest that was accrued because it's in 2 different accounting periods, 2 different years, right? So we make an adjusting entry at the end of December in order to account for any interest expense incurred during that year. That's because of the matching principle, remember? Yeah. So here's an example of that type of thing happening. December 31, we made the adjusting entry by debiting interest expense, crediting interest payable. And then in February of the following year, we made the payment of that loan. So we debit interest expense, debit interest payable. That's the carryover from the previous year. Debit notes payable, the face value. We credit cash. Now, the moment we've been waiting for, payroll. Payroll can be a very complex subject. That's why we have payroll accountants. That's a real job. Yeah, that's all their job is to do is payroll. It's a human resources function. Yeah. Those of you who are working in human resources, or thinking about working in human resources, oftentimes payroll falls under human resources department. Very common. It's technically accounting, but it falls under human resources. Very normal. There's usually a person dedicated to doing payroll. That person's usually pretty miserable every single month. That was always entertaining to work with payroll accountants. They always seem so disappointed. I don't know why. It's just, I don't know, whatever. It must be the job. So let's talk about employee payroll deductions and liabilities, and then we'll talk about the deductions from the employer as well. For the employee, for all of us working, take a look, pull out your paycheck stub, okay, and follow along, because you're going to see a lot of similarities. Payroll liabilities. We, the employees, have to pay a couple things, right? Sure, we get paid whatever's left over, but we have to pay state tax, federal tax, local tax, sometimes. And then the deductions for things like retirement, child care, child support, educational deductions, plus whatever else. There's a lot of different kinds of deductions. Or you might have like a healthcare deduction, what they call a savings account, health savings account. All those things are deducted from your paycheck, right? They go into these respective categories, and then your employer pays them on your behalf. That's how it works. So payroll liabilities are for salaries, for anyone who gets paid, basically, employee benefits and payroll taxes levied by the employer. This graph kind of sums it up for us. Okay, first, actually kind of backward, not terribly. First, we pay federal income tax off of our gross pay. So the gross amount is what we earned. So, for example, I'll break out my calculator here. So, for example, let's say that you worked 40 hours a week and you made $20 an hour. Decent wage, by the way. $800 per week. That's pretty good pay. Every 2 weeks, you made $1,600 in gross pay. Okay? Then you had to pay federal income tax. Let's say the federal income tax is 27% in the higher bracket. It's lower than that, I don't know. It's probably a little lower. So times 0.27 means you had to pay $432 in federal income tax. So $1,600 minus $432. Now you're down to $1,168. Then you have to pay taxes to the DC government. DC government wants another 25%, we'll say. Times 0.25, that's $292. So $1,168 minus $292. Now you're down to $876. And then let's say you have a retirement contribution that you make of $20. Brings you down to $856. Then let's say you have some child care expenses that are non-taxable, so minus $40. Then let's say, oh, that's good. That's a lot. And then, but don't forget, you have to pay Medicare and Social Security. Medicare is 6%, so time 1,600, 0.06. You see where we're going with this, right? So we take your gross pay of $1,600, subtract out your federal income tax of $400, We subtract out your DC income tax, another 300, we'll say. Subtract out your Medicare, which is 3%, I think it is, of your gross pay. And then your Social Security, 6% gross pay. Yeah. Then any other deductions. But really, your voluntary deductions come out first because they're non-taxable. Yeah. Equals your net pay. Isn't that a mess? Yeah, it really is. So gross pay minus deductions, then minus federal, state, Medicare, Social Security equals net pay. Yeah. So let's talk about this. The Federal Insurance Contributions Act. So we, as employees, we pay Social Security and Medicare. Social Security was designed to be kind of like a retirement savings account for you. Okay, when you retire at a very ripe age. Some of us might not see it. Hopefully we do. It's Social Security's in trouble. I'll tell you that much. Social Security is like a forced government savings account for when you retire. 6.2%. I think it's higher than that now. That was back in 2018. I want to say it's closer to 7% now. It's growing. They tax you 6.2% of all of your gross wages for Social Security. And you also pay into what we call Medicare. Medicare is a form of government health insurance. Yeah. So when you retire, this is your health insurance after the age of, I think you got to be 65 or 67, right, to collect Medicare. Medicare is health insurance for the elderly. Yeah, when you retire. We pay, as of 2018, 1.45%. I want to say it's closer to 2% today in the Medicare. All employees must pay into these two things. Now, I will also say the employers do as well. The way it works is that you take your gross pay, multiply it by these percentages, and that's the amount you pay into Social Security and Medicare respectively. The way it works is that the employer takes these out of your paycheck, they hold on to it, and then they send it to the IRS. And the IRS distributes it accordingly to the respective agencies. I think. I'm pretty sure that's the way it works. Employers also have to pay into your Social Security and your Medicare. They match you on your contributions to these things. Same percentages. That might be a little less on maybe one of them or two. So the amounts depend on your earnings, your tax rate, number of withholdings, etc. When you were first hired for your job, you filled out what's called a W-4 form. This W-4 helped you to identify things like withholdings, etc. You said how many kids you got, put it on the withholdings, and it kind of gives you an idea of what your tax situation is going to look like every single year. So if you're like me and you owe money to the IRS every single year, you might want to check your withholdings and reduce them. It means they'll take more out up front, but you won't have to pay as much at the end of every year. Well, the opposite's also true. If you keep getting massive refunds, it means that you're giving them too much of your money. I want to put an allowance in there to reduce that. You want to, the idea is that you don't want a refund and you don't want to have to owe money. You want to be as close to zero as possible. That's the idea. If you're getting a big refund, that means you're paying too much up front of every paycheck. So look into it. That's all I'm saying about it. Employers and employees have to pay, they both have to pay, based off of the gross pay appropriate to government agencies. So the amount that you pay into Social Security and into Medicare, the employer also has to pay that same amount. When it comes to federal and state and local, also known as city, income taxes, the employer takes that out of your paycheck and then they distribute that to the appropriate agencies. Remember, the employer kind of acts as an intermediary between you and the government when it comes to taxes. Some of you might also have the voluntary deductions. Union dues, savings accounts like health savings accounts, pension contributions, retirement contributions, insurance premiums, charities, child support, child care, etc. All these, we call these deductions. Yeah. And there are amounts withheld at your request. Most of the time at your request. Sometimes it's not your request. You know what I'm saying? The employers withhold these and then provide those to the designated agencies, just like they do with taxes. Here's an example of a payroll check. This employee received $2,000 in gross pay. Gross pay. $2,000 in gross pay. Before taxes. When you hear the word gross, it means before taxes. This employee pays 6.2% to Social Security, 1.45% to Medicare. They also paid federal income tax. State tax? They must live in Florida. Medical insurance, union dues. So, gross pay, $2,000. Social Security, $124. $29 to Medicare. Federal tax was $213. The price of state tax is missing. Employee medical insurance, $85. Union dues, $25. The net pay is what we call salaries payable. $1,524 is what the employee received or will receive once we write the check. Yeah. So this journal entry that we just described here at the top, this is what we would enter into our accounting system as a general journal entry for payroll. Debit salaries expense and then credit all of the payables, all the liability accounts. Then we pay the employee. And debit salaries payable and credit cash. I had mentioned that the employer also has to pay taxes. Same as you, similar as you. Not all of them. But they also have to pay a different tax. It's called unemployment insurance. We're going to talk about these things. So the employer pays the taxes equal to you. I'm sorry. Oh, sorry. The employer pays the same amount that you pay into your Social Security account and into your Medicare account. The same amount that you paid into those accounts, the employer also paid. The difference here is that the employer also pays federal and state unemployment taxes. If you ever become unemployed for whatever reason, global pandemic, or something else happens in the future, you become unemployed temporarily. When you go to file for unemployment, did you ever wonder where that money came from? Your employers, your previous employers paid into an account called unemployment taxes on your behalf based off of the amount that you earned. Okay? Obviously a lot less. It's not the same amount. It's like a very small percentage. But the point is, employers paid into unemployment taxes. So if you ever got unemployment for whatever reason, that's where the money came from. It was based off of the amount of time that you worked, your hourly rate, and the percentage that the employers had to pay in. The federal unemployment tax, 6% of all of your wages go into this. You don't pay it, the employer does. They get a credit, 5.4%, and the net rate is 0.6. It's not a lot. On the state side of things, it depends on the state. 5.4% is the average, but the first $7,000 goes into state unemployment. That's why state unemployment is always higher than the federal. Federal is usually nothing or very low. Here's an example of a journal entry that we would make at the end of each year, end of each quarter or month. For these payroll taxes that the employer pays, we debit payroll tax expense, then we credit Social Security, Medicare, state unemployment, and federal unemployment. It's based off the unemployment is based off of percentages designated by Congress and by the state. Again, payroll is usually done by human resources. Human resources usually takes care of payroll. Very, very common in most businesses. It's an accounting function. It's an accounting concept. Payroll's all about accounting, but it's usually a human resources function. It's important to keep these areas separated and monitored at all times. Employee hiring, payroll preparation, timekeeping, and payroll payment. Here's why. In most businesses, a separate person is responsible for payroll, which is separate from timekeeping and separate from hiring. Usually the person in the human resources department that does the hiring is not the same person that does the payroll. Those should be kept separate. For the obvious reasons. Things can go awry there, yeah? So it's important that these are kept separate. I talked about briefly previously multi-period known liabilities. These are known payments that we have to make every single month or every single year. Include things like unearned revenue, notes payable, things we know that are going to happen. Yep. Okay. Switching gears a little bit from payroll, are there any questions at all about payroll taxes, any of the liabilities that we talked about? Doing okay? Did I bore you to death? Y'all still there?
Yes, I'm still here, Professor.
Okay, thank you.
Me too.
Fast-
All right, that's good. I'm happy you're all still there. All right, right on. I know it. Sometimes it gets a little dry. You know how it is. This is accounting. This isn't, creativeness. But it's something that's important. Okay, let's talk about estimated liabilities and warranties and bonuses. Sometimes bonuses are nice, right? It's nice to get a bonus every so often. I haven't seen one of those in a long time. In fact, I don't think I'll ever see one. Anyway, estimated liabilities. We talked about this briefly when we talked about uncollectibles. Remember? We said that a certain percentage of our customers, they might not pay us. No, it happens from time to time. It's unfortunate. We estimate that. Remember? There's a way to estimate it. A couple ways to estimate it. Estimated liability is known as a known obligation for an uncertain amount that can be reasonably estimated. I might not get payment from a customer, or I might have to pay something, right? Example would be a warranty. A warranty, and I'll talk about this here in more detail in a second. A warranty is when you receive a document that says, hey, if this breaks in the future, we'll fix it for you within a certain amount of time. You might have a warranty on your car for the first 2 years or whatever. You might have a warranty on a new television set that you bought, or on a new computer, or your new phone. And the warranty might be short term. Limited liability warranty is what they call it, right? Or a limited warranty. It only covers certain things. It doesn't cover it if you dropped your phone into, the bathroom sink. Or you decided to take it into the shower with you for whatever reason. Or if you decided to go swimming with it. Or if you gave it to a 2-year-old child. Right? It only covers certain things. Oh, that's a warranty. It's a limited warranty. Companies that offer a limited warranty, they estimate that a certain percentage of customers will actually use it. Usually very low. But that is an estimated liability. We'll talk about that. Yeah, warranties, vacation pay, health care, pensions, etc. These are all examples of liabilities that we know will happen, but we're not too sure the exact amount. Here's an example of employer expenses for pensions and medical, life, dental, disability insurance, etc. They're all benefits covered by the employer. These benefits covered by the employer, we expect that a certain percentage of our employees will use this stuff. They might retire. They might need medical insurance. They might use this stuff. So we anticipate that. We say, 10% of our employees are going to use this. So that's how we calculate it. So we debit the journal entry that we would make when we estimate the amount is we debit employee benefit expense and we credit all of the different benefit payables medical insurance payable, retirement program payable, etc. Keep going. Vacation benefits. This one's pretty common. I think it's common, mostly. If you have vacation benefits and you don't take vacation, you should take vacation. Yeah, take care of yourself. It's important to take care of yourself for both your mental health and physical health reasons. Yeah. Vacation benefits, very nice. They accrue over time. It's usually a few hours a week, right, that accrue over time. You might get up to 2 weeks a year. Hey, maybe if you got a good company, you might have 4 weeks a year. Right? It's sometimes based off of the amount of service that you have with the company, length of service. So here we have an employee that is going to be taking some leave. They're going to take their vacation. So we debit vacation benefit expense and we credit vacation benefits payable. When the employee actually takes the vacation and it's time to pay them, we debit vacation benefits payable and we credit cash. Bonuses. Oh, this is nice. I feel lucky for you if you get a bonus. Yeah, that's fantastic. Bonuses. Sometimes employers like to pay bonuses out. Maybe you got a signing bonus. You sign up you're working for a new company. They give you a signing bonus. Or they had a really good year with sales. They gave you a bonus. Very nice. Bonuses paid to the employees, shared by all. We debit employee bonus expense and credit bonus payable. Bonuses, it's important that you know this. When you actually get paid out a bonus, yeah, it's nice, but it gets taxed at a higher rate. Yeah. Set aside a little bit more for Uncle Sam if you get a bonus. Warranties. Bought that new TV, doesn't work as you expected it in the first year or so. So you contact the manufacturer, say, oh, it's within warranty. Yeah, no problem. We'll come and fix it for you. So they send somebody down to fix the TV. Hopefully they can fix it. If they cannot, they'll replace it. It's called a limited warranty. They fix or replace a product when it doesn't work as expected within a certain amount of time. The company that sold the TV, or the manufacturer in this case, reports this warranty as an expense and as a liability. It's an expense when the customer calls for the warranty. It's a liability based off of a percentage. We expect a certain amount of customers are going to call the company and request a warranty replacement or repair. So here are the examples. Here's a car. Okay, this is a good one. Car, $16,000. Man, I don't know if that's a pretty good price. 1 year warranty. So because it has a 1 year warranty, we estimate that the customer might need to use that warranty. So we debit warranty expense and we credit estimated warranty liability. Then let's say the customer actually uses it. Okay, whoops. When that happens, we debit estimated warranty liability and we credit the parts for the repair. Yep. It happens. But this it just shows you the example of company budgeting for the use of a warranty and then the warranty actually taking place. One of the last concepts I'm going to talk about tonight is accounting for contingent liabilities. Sometimes a liability might not happen. Sometimes it will happen. Sometimes there's a high probability of something happening. We call this a contingent liability. Look at the liability and we say, what is the probability of this actually happening? For example, liability is, we'll say, insurance. What is the probability of Dr. B getting in some trouble? Probably not that high. But in case I do, I have liability insurance. So we look at the liability insurance. The future event, is it probable? Is it possible or is it remote? If it's probable, then we're going to estimate that we're going to have to pay out that insurance. Estimate it, and then we record the journal entry. If we can't estimate the amount for the insurance, then we simply put that in the notes of the statement. We put it in the notes of the balance sheet. It's a note, this might happen, not too sure, don't know the amount. Put it in the notes. If it's possible, we just put it in the notes. If it's remote, meaning Dr. B's probably not going to get in trouble ever. He's a pretty clean-cut guy. It's remote. It's a non-disclosure. We don't even talk about it. So that's contingent liability. We look at the liability, determine its probability, estimate it or don't estimate it based off its probability. And then if it's possible, we disclose it. If it's remote, we don't do anything with it. A couple of examples. Legal claims, debt guarantees, other contingencies. These are relatively rare, but they happen from time to time. Depends on your business, really. Depends on the type of business that you're in. Some uncertainties, dealing with uncertainties with liabilities. It's a lot of times just a matter of disclosing. When in doubt, disclose, disclose, disclose. And of course, with this wouldn't be an accounting class without a ratio. Every accounting class has a ratio, I think. This one's called times interest earned. It's the income before interest and income taxes divided by interest expense. That sounds like a lot. Income before interest and income taxes is found toward the end of the income statement, just before we get to the interest and the taxes. Right? It's a literal line item on the income statement. And of course, interest expense, also a line item on the income statement under expenses. Interest expense. This helps us to identify the probability of positive return if a customer is unable, or if the business is unable to pay in the future. This is the type of calculation we will make. It's really a risk. I call this more of a risk ratio. Example of it from a company. Very straightforward. There's a couple of reports. These are more managerial reports that come out of payroll. For payroll reports, we got IRS Form 940, the W-2, IRS Form 941. Payroll records, there's the register, payroll checks, employee earnings report, and pay stubs. People forget about that part. Payroll procedures, etc. Just these are just documents that are required for the government, for the business to have but they're more managerial than anything else. It's important you know that they're there. And then last but not least, income tax for the corporation. Corporations, as you should know, are treated like individual people. So they themselves also have to pay various taxes, right? Income tax for the corporation itself. These are just a couple of examples of those kind of journal entries that we would make. And that, my friends, is the end of our 11th chapter of our course together. Very quickly, as we're wrapping up, I want to call your attention to what is due on Thursday. So if you could, I would really, really appreciate it if you would post your original discussion for Chapter 11 by Thursday night. That would be ideal. Thank you, Paulette. This is very nice. Wow, that's great detail. Oh, love it. Oh, nice images. This looks like you got it from a very good source. Okay, Accounting Coach, yeah. Yes, I'm seeing wonderful posts. Maxine, very well done. Wow, holy smokes, I'm loving the detail. Tamara, very well. Yeah, Jermaine, yeah, this is good stuff. Okay, so please follow your classmates' examples here. Very, very well done. I sincerely appreciate you working ahead. If you could, please be sure to make your discussion post by Thursday night, your first one, and then respond to two of your classmates. I'll also jump in there and provide my own response to the discussion post prompt, and I'll also respond to a few of you as well. So please do that. I would really appreciate it. Again, it's worth 5% of your grade, so it's definitely a good thing to do. So yeah, please do it. Absolutely. And I appreciate all of you that have done it so far already. With it, if you have any questions, comments, or concerns, as always, you can email me, call me, set up office hours. Whatever you need, I'm here for you. And I sincerely appreciate all of you. Thank you again for a wonderful class together so far. I look forward to seeing you again next week. If you need anything, I'm here for you. Thank you so much. Remember to stay safe, wash your hands, do the right things, and I'll see you all again next time. Thank you so much. Take care. Bye-bye.
All right, Professor.
Okay. Thanks, Professor.